Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
Yeah, it's great to be here.
I was looking at the calendar this morning,
Hmm.
and it's February 2026. We're well into the new year. President Trump is back in the White House, and the headlines are just,
Chaotic.
yeah, chaotic is the word. You've got tariffs, policy shifts, and honestly, looking at the stock market right now feels a bit like trying to read a map upside down.
It's definitely disorienting. I mean, the old rules that worked so well for the last, 3 years.
Right, basically just buying big tech and holding on for dear life.
Exactly. Those rules are they're starting to flicker a bit.
And that is exactly what I want to dig into for this deep dive today. We have two major puzzles in the financial world that, on the surface at least, make zero sense.
Right.
First, we have Stanley Druckenmiller. I mean, the guy is a legend, probably one of the greatest investors alive.
Absolutely. When he moves money, the whole market pays attention.
But according to recent analysis, he's making a move that looks like a total contradiction. He is effectively betting against the biggest winners in the stock market.
The tech giants.
Yeah, the tech giants we all know and love. But at the same time, he's screaming that he is bullish on America. So, how can you love the U.S. economy but bet against its biggest players?
It sounds like a paradox, doesn't it? But he's actually playing a very specific mathematical game.
Right. And then puzzle number two takes us across the ocean to Asia. Because according to the data, we're seeing foreign investors, people like us here in the U.S., pouring billions of dollars into Asian stocks.
Yep.
But at the exact same time, the local traders in those countries are selling everything they can get their hands on.
The classic two foreigners problem. It's a case of split personalities in the market.
So that's our mission today. We need to untangle these wires. We're going to look at why the easy trades might be over and break down these complex mechanics so they actually make sense, like ordering lunch.
I love it. I'm ready. Let's get into it.
So let's start with Druckenmiller. The ticker symbol everyone is whispering about is RSP, which stands for the Equal Weight S&P 500.
Correct.
Now, most of our listeners know the standard S&P 500. It's the benchmark.
Yeah.
If you buy SPY or VOO in your normal 401k, you own the 500 biggest companies in America.
Right. It's the default.
So why is Druckenmiller abandoning that for this equal weight version? What is the actual difference there?
Well, to understand the move, you really have to understand a fundamental flaw or, well, a feature, depending how you look at it, of the standard S&P 500. It is not a democracy.
Okay.
It's an oligarchy.
An oligarchy. That sounds a bit dramatic.
It is,
Yeah.
because the standard index is market cap weighted. That means the bigger your company is, the more influence you have on the index.
Okay, give me an everyday example of that.
Sure. Imagine a massive pizza party,
I'm in.
right? A party for 500 guests, and these guests represent the 500 companies. In the standard version, the one sitting in your retirement account right now, the guests get fed based on their size.
Oh, I see where this is going.
Yeah. So Nvidia, Apple, and Microsoft walk into the room. They don't just politely take a slice. The three of them devour nearly 20% of the entire pizza before anyone else even gets to the table.
Wow. That is a ridiculous amount of pizza for three people.
It's historic. According to the data from this month, February 2026, those top three companies alone make up about 19.4% of the index.
Almost a fifth of the whole market.
Exactly. That is an incredible concentration of risk. If you buy the standard S&P 500 right now, you aren't really diversified at all. You're effectively making a heavily leveraged bet that three tech companies will just keep winning forever.
So if Nvidia trips and falls, the whole party gets ruined.
Yeah. Even if the other 497 guests, the laundry machine makers, the cereal companies, the local banks, even if they are having a great time, it just doesn't matter if the big three get sick. The index goes down.
Okay, so then what is this equal weight party that Druckenmiller is going to?
The equal weight version, RSP, changes the rules entirely. At this party, every single guest gets exactly one slice of pizza.
One slice each.
Yeah.
Period.
Period. No matter who you are. The trillion-dollar AI giant gets one slice. And the much smaller, industrial parts company in Ohio?
They get one slice too.
Exactly. It completely removes the size advantage.
Well, that sounds fair, but why is this the smart play right now? I mean, why didn't he do this 5 years ago when tech was printing money?
Because of a concept called broadening.
Broadening.
Yeah. For the last few years, the U.S. economy was basically a one-man show. It was big tech or nothing. But now, with the new administration, shifts in the global economy, we're seeing signs that the generals, the tech giants, are tired.
They've run too far too fast.
Exactly. And the soldiers are finally catching up.
The other 493 companies.
Right. Energy, industrials, financials, they're starting to wake up. So Druckenmiller isn't betting against America at all. He's betting that the average American company is about to outperform the superstar company.
Okay, that makes total sense. It's a rotation. But I got to challenge you on something here.
Go for it.
It sounds really nice to say everyone gets a slice.
Yeah.
Very democratic. But practically speaking, does this actually make you money?
What do you mean?
Well, if Nvidia doubles in price again, and I'm in the standard index, I win big because I own a ton of Nvidia. In the equal weight index, I only have a tiny little slice of it. Doesn't that cap my upside? Aren't I leaving money on the table?
In a runaway bull market led by a few stars, yes, you absolutely leave money on the table. There's no getting around that.
Right.
But the equal weight strategy has a hidden engine under the hood. It generates returns in a completely different way. It relies on the magic of rebalancing.
The magic of rebalancing. How exactly does that work?
It's a disciplined mathematical rule. The fund actually forces you to buy low and sell high, whether you want to or not.
Oh, that's interesting. Walk me through the mechanics of that.
Let's go back to the pizza analogy.
Huh.
Every quarter, the fund has to reset the table so everyone has exactly one slice again.
Okay.
So let's say the big tech company stock went up 50% since the last meeting. They now have a slice and a half on their plate.
They're hoarding pizza.
Right. And let's say the boring bank stock went down. They only have half a slice left. At the end of the quarter, the fund automatically sells that extra half slice from the tech company.
Selling high.
Yep. And it uses that cash to buy more of the bank's stock buying low to get it back to a full slice.
Oh, I see. So it forces you to trim the winners and double down on the losers.
Exactly. Think of it like gardening. You're automatically trimming the tall hedges that are sticking out, and you're watering the short ones. It removes all human emotion from the equation.
Which is usually where we mess up.
Oh, totally. You aren't chasing the hot stock. You are constantly taking profits from it.
But playing devil's advocate here, that has to be psychologically brutal.
It is incredibly painful.
Because if I'm in this fund and I turn on the TV and hear that AI stocks are going to the moon, and I know my fund is actively selling them,
You're going to feel like an idiot.
yeah, I'm going to feel like I'm missing the biggest party on earth.
And you might be. If we get another massive tech bubble in 2026, where just a few companies skyrocket, the equal weight strategy will underperform. You'll look at your statement and say, why didn't I just buy the regular index?
So this is really a contrarian bet. You have to believe the giants are overvalued.
Or at least fully valued. And there is another risk we really should mention here. This isn't just about missing out on gains, it's also about safety.
Safety. I would think spreading your money out evenly is safer.
Not always, because remember who those other 493 companies are? They're smaller, they often have more debt.
Right, they aren't the apples of the world.
Exactly. They don't have $100 billion in cash sitting in the bank like Google or Microsoft. If the economy crashes, if we hit a hard recession, those smaller companies are much more fragile.
They might go bankrupt while the tech giants just shrug it off.
That's the risk. The equal weight fund exposes you to the real economy, warts and all. Whereas the standard S&P 500 is basically a fortress built out of the richest companies in human history.
That is a perfect way to put it. So for the listener trying to figure this out, do they have to choose? Is it Team Pizza Party or Team Fortress?
It's rarely an all-or-nothing choice. Most smart investors use what we call a core and satellite approach.
Core and satellite. I like the sound of that.
Yeah, so you keep the standard S&P 500, the market cap version, as your core. That's your foundation. You want that exposure to the giants because, let's face it, they are incredible companies.
Right.
But then you add the equal weight fund as a satellite, maybe 10% or 20% of your portfolio.
Oh, so you're hedging your bets. If tech keeps ripping, your core wins. But if the rally broadens out to the rest of America like Druckenmiller thinks, your satellite captures that growth.
Exactly. You get to eat at the fancy table with the VIPs, but you also make sure you aren't starving if the VIPs suddenly decide to leave the room.
That makes a lot of sense. Now, speaking of leaving the room, let's travel.
Let's do it.
We need to talk about Asia, specifically Korea and Japan.
The Asian market paradox.
Yeah, this one really confused me when I was looking through the research. We have this phenomenon of the two foreigners.
Yes, it's fascinating.
Let's look at the data. According to recent reports, if you look at offshore money, meaning ETF listed right here in the U.S., money's just pouring in.
Huge amounts.
Yeah. For the Korean ETF, the ticker is EWY, we've seen about $2.7 billion flow in this year alone.
That is a massive amount of buying pressure from the U.S. side.
Right. That's American retail investors and funds saying, I want to buy Korea.
Yeah.
But If you fly to Seoul and look at the actual local stock market, the onshore market, foreign investors are selling aggressively.
Very aggressively.
They've dumped about $9 trillion worth of stock.
Specifically unloading heavyweights like Samsung Electronics.
So wait, how can foreign investors be pouring billions in via ETFs here and pulling billions out of the local market over there at the exact same time? Are they just confused?
They aren't confused at all. They're just different people playing entirely different games. To explain this, I like to use the analogy of the tourist versus the roommate.
Okay, break this down for me.
So the ETF buyer, the one pouring money into EWY here in the US, is the tourist. Or maybe a better term is the long-distance romantic.
The romantic. I like that.
These are pension funds, asset allocators, or even just retail investors here in the States. They are looking at the big picture map. They see that the U.S. market is expensive, trading at really high multiples.
Because of the tech giants we just talked about.
Exactly. Then they look at Korea or Japan and see stocks trading at bargain basement prices.
So they see a deal.
They see pure value. They're buying the idea of Asia. They're thinking 5, maybe 10 years down the road. They think, the U.S. dollar will eventually weaken. Asia will rise. I need to be there now.
Yeah.
They are buying the dream.
Okay, so the tourists are arriving with their suitcases full of cash. Who's doing all the selling then?
The roommate.
The roommate, yeah.
These are the hedge funds and active traders who actually operate in the Asian time zones. They aren't looking at a 10-year chart. They are looking at the messy reality of living there day to day.
And what do they see that the romantic tourists don't?
They see the dirty dishes in the sink. And specifically, those dirty dishes are currency risk.
Currency risk. Why is that such a deal breaker?
Well, look at the Korean won or the Japanese yen recently. They have been very weak against the U.S. dollar. And if you're a hedge fund, that is terrifying.
Why? I mean, if the stock goes up, don't you make money?
Not if the currency crashes. Imagine you buy a Korean stock, great company, does well, goes up 5%, awesome.
Right.
But in that same week, the Korean won drops 10% against the dollar. When you go to convert your money back, you've actually lost 5% overall.
Oh, wow. So you're basically swimming upstream. The current is pushing you backward faster than you can swim forward.
Exactly. So what do the roommates, the local hedge funds, do? They hedge. They might actually really like the companies, but they don't trust the currency environment right now, so they sell futures.
Selling futures. Okay, that sounds a bit technical. What does that actually mean for the average listener?
Basically, they are placing a bet that the market will go down just to protect themselves. They're selling the big liquid stocks like Samsung or shorting the entire index to neutralize their risk. They're just trying to strip out the danger of the currency falling out from under them.
So the selling isn't necessarily because they hate Samsung or hate the Korean economy. It's because they're terrified of the macroeconomic environment.
Precisely. It's a vote of no confidence in short-term stability, not necessarily long-term value.
That completely explains why you can have massive inflows and massive outflows at the exact same time. The ETF money is, well, dumb money. And I don't mean that as an insult, but it's passive.
Right, it's systematic.
It just flows where the algorithm or the model tells it to go.
Yes. And crucially, it hits the market with a lag. When you buy an ETF on your phone in the US, that money doesn't instantly teleport to Seoul and buy shares. There are intermediaries, swaps, structural delays.
But the hedge fund selling?
That is immediate. That's a trader sitting in Hong Kong or Seoul hitting the sell button right now. That price action hits the tape instantly and drags the local market down.
So we basically have a real-time battle between long-term value and short-term fear.
That is the perfect summary. Value versus fear. The tourists are saying it's so cheap, and the roommates are saying it's too dangerous.
So for the listener trying to figure out if they should actually invest in Asia right now,
Yeah.
who is right? Who wins this tug of war?
Usually a real sustained bull market only starts when both groups agree.
When the roommate and the tourist both think the party is fun.
Exactly. Right now, the tourists are knocking on the front door with bags of cash, but the roommates are actively barricading the door from the inside.
Wow.
You really want to wait for the moment when the hedge funds stop selling, which usually happens when the currency finally stabilizes.
Yeah.
That is when all those ETF inflows will actually start pushing the stock prices up.
So the lesson is don't catch a falling knife just because you saw a headline about massive ETF inflows.
Correct. Context is everything. If you are a true long-term investor, maybe you act like a tourist and just ignore the noise. But you have to know that the short-term ride is going to be incredibly bumpy, because the locals are nervous.
This has been incredibly clarifying. We aren't just looking at stock tickers here. We're looking at the psychology of the people moving the money.
That really is the only way to truly understand the market.
So let's try to bring this all together. We've covered pizza parties, hedge trimming, and roommates arguing in Seoul. If our listener is sitting there, maybe checking their portfolio on their phone right now, what are the big takeaways?
I think there are two main lessons for you today.
Hit me with the first one.
First, don't be lazy with your U.S. exposure. For a long time, the U.S. market was a one-man show starring big tech. You could just buy the standard index and go to sleep.
But now the script is flipping.
The script is changing to a team effort. The broadening is real. Whether you use the equal weight strategy we discussed or just look at other sectors like industrials and financials, you need to acknowledge that the rest of the S&P 500 is waking up.
Right.
Don't be the last person solely holding the bag on the giants if they stall out.
I love that. Diversify beyond the celebrities.
Perfect.
And the second lesson.
Dig deeper into the data. We saw this perfectly with the Asian paradox. Just because you see a headline saying billions flowing into ETFs, it doesn't automatically mean the local market is booming.
Right. Look past the headline.
You have to ask yourself, what time frame am I playing? Are you acting like a pension fund with a 10-year horizon? Or are you acting like a nervous trader worrying about next week's currency drop?
Know your timeline. That is crucial advice for anyone listening.
If you are a long-term investor, the messy volatility in Asia right now might actually be a great opportunity because the roommates are selling in a panic.
Yeah.
But if you need that money next year to buy a house, listen to the roommates. They see the short-term risks that you are missing.
This has been great.
Yeah.
I feel like I understand the actual flow of money so much better now.
It's always a pleasure to look under the hood with you.
Before we go, we always like to leave our listeners with a final thought, something to chew on.
Well, here's my question for you as we move deeper into 2026. We are seeing a massive tug of war across the board. On one side, we have the stars of the last few years, the mega-cap tech giants, and the U.S. dollar.
Right.
On the other side, we have the underdogs, the average S&P stock, the Asian markets that have been totally beaten down.
The stars versus the underdogs.
My question is, are you betting on the stars finding a second wind? Or are you betting on the underdogs finally having their day? Because historically, when the underdogs start to run, they can run further and faster than anyone expects.
But betting on them requires patience.
And the stomach to be wrong for a while before you're right.
Exactly. That is a great question to end on. Are you team star or team underdog? Something to think about as you check your portfolio this week. Thank you so much for listening to this deep dive. We hope this cleared up the confusion in the markets for you. Don't forget to subscribe and hit that like button.